Berkshire Hathaway is going to finally bid farewell to Warren Buffett. He plans to step down as chief executive at the end of the year. He is going to be succeeded by Greg Abel, a Calgary native and a long-time Berkshire executive, and he's long been considered the heir apparent. Let's get more from Mark Sebastian, founder of Option Pit and chief investment officer at Karman Line Capital. Mark, great to see you. Happy Monday. I guess it was inevitable. Buffett, he's 94. He had to go eventually.
Yeah, absolutely. And this is much better than him dying while still the CEO. That the stock would be performing much differently if that happened. I used to joke that I loved Warren's alpha, but I was terrified of his omega. But they have kind of cleaned that up now, and now there's a succession plan. So, seeing a little weakness, there's that cult of Warren Buffett. You may see people, continue to sell here a little bit, but if they do follow the plan of, follow the Warren Buffett way, any weakness over the next few months is probably gonna pay off for buyers.
I mean, if he had died while in the job, you feel that people might worry there wasn't a succession plan fully worked out, or?
Yes, and just I think the sheer shock of that would have also pushed it. I think it would have been down 10% or more if that had happened.
It is interesting. I mean, we as investors, we don't always take Buffett's advice to heart, do we? For example, the whole favorite holding period being forever. People think they can trade and beat the market.
Yeah, I mean, that's why most people don't outperform the S&P 500. 90% of hedge funds don't outperform the S&P 500. Now, some are looking for a different kind of return, but that's why having a broad investment portfolio with something like SPY, things along those lines, makes a lot of sense. I think Warren Buffett has often said that, can't beat the market, just buy it. Because
he has in the past said, I think most investors should just own an index fund. So, yeah. The President Trump musing about 100% tariff on non-American made films. You reckon that's a gift for the Hollywood unions, for one thing?
Yeah, more stuff made in Hollywood is definitely good for Hollywood unions. I don't really know kind of what this really is about. We've seen these executive orders. At first, people are shocked, and then as we get into details, there's less and less pain actually around because, how many movies are actually made in California anymore, right? I think there's probably more made in Toronto than there are made in Los Angeles at this point. So, but I think once we get the details out, this will end up being a bit of a nothing burger.
Right. And I mean, movies are global. You seem to see Hungarian post-production a lot, and editing and special effects. And yeah, it's kind of trying to draw that distinction between US and foreign-made films seems a bit arbitrary. We've got Sketcher. We've got quite a few privatization transactions. We've got 2 in Toronto, and we've got Skechers in the sights of 3G Capital here.
Yeah. Well, take a look at the retail sector as a whole that is not Walmart or Amazon. It's really not a very pretty picture over the last year. So doesn't surprise me that with, how far some of these names have fallen, that you're starting to see private equity kind of snoop around. There are a lot of names out there in that 1 billion to kind of 5 billion range that might be interesting to a private equity investor. Abercrombie and Fitch, a Revolve, an American Eagle. There are a lot of names out there that are in that range that do make some money that private equity might be interested in at the current valuations.
Especially in retail and apparel?
Yeah, I mean, that appears, those are the sectors, like especially apparel, that have really gotten beaten down. Just relative to with this Skechers buyout, it just kind of made me look at what other names might be interesting out there, and those were 3 of the names that I came up with.
The market, you're not surprised that after 9 days of gains for the S&P 500, the market's taking something of a breather today?
No, I mean, that last week's rally was really strong and constructive. We rallied and Apple was down on the week. That tells me that there's broad buying kind of across the spectrum. We saw some stronger performance last week out of the Russell 2000. So another really good sign that buying is broadening out. The volatility index is really starting to ease off. I think they're post-Fed this week. We could see the VIX fall back below 20. So the only real wrench for this market, I think this is a week where if there wasn't a Fed, we would just kind of meander around, maybe end the week up, 0.5% or something like that. But with the Fed in there, that's kind of the one wrench, I think, to the market. The 30-year yield is about 4.83%. That's getting toward the upper edge of where the Fed, I believe, is comfortable. We get a 10-year yield approaching 4.5. The Fed's not going to like that. I think they're going to kind of forced into a dovish corner here. I'm interested in what they're going to say, but I think the Fed is forced into a dovish corner because of where rates currently are sitting.
Sure enough, yeah, the Federal Reserve meeting coming up on Wednesday. Mark, thank you very much indeed.
Have a good week.
You too. Mark Sebastian.